You have never lost everything. So you believe you know how to manage risk. That belief is not based on skill. It is based on the fact that the thing that will destroy you has not arrived yet. And you have been using that silence as evidence that you are safe. You have a plan. Maybe it is a salary, a savings account, a portfolio spread across a few different funds. You did the responsible thing. You did not put it all in one stock. You have 3 months of expenses set aside. You have insurance. You have thought about the future more than most people you know, and you feel not completely safe, but reasonably protected. Like someone who has done the work and earned the right to stop worrying. Now think about what your plan was built on. It was built on conditions you have already experienced. The job market you know. The interest rates you have seen. The kind of disruptions that have happened in your lifetime. Your plan is a model. And every model is built from the past. The past is the only data you have, and the thing that will break you will not look like anything in that data. That is not a flaw in your planning. That is the nature of the event that ends you. There is a specific kind of risk that does not show up in any forecast. It is not the risk you are watching for. It is not the risk anyone is watching for. It is the event that exists outside the range of everything that has happened before. Call it a tail risk. An extreme outcome so far from normal that every model, every spreadsheet, every diversified portfolio was built as if it could not exist. The analogy is simple. You have been practicing for rain. You have an umbrella, you have a jacket, you have checked the forecast, and none of that has anything to do with what happens when the river floods the ground floor. Your savings account is not a plan for the thing outside your experience. It is a plan for the things inside it. And those two categories are not the same size. In the spring of 1994, Robert Citron is the treasurer of Orange County, California. He manages $7.5 billion of public money, the retirement funds of county workers, the operating budgets of schools and public services. He has been doing this job for 23 years. He is not reckless. He is celebrated. He has produced returns that other counties cannot match, and nobody in California government has asked him to explain how. He is borrowing money at short-term interest rates and investing it in long-term securities. When short-term rates stay low, this produces steady gains. It has worked for years. The model says it will keep working. Citron says it will keep working. Wall Street firms are lending him the money to do it and collecting their fees without asking questions, the answers to which might end the relationship. In February 1994, the Federal Reserve raises interest rates, then raises them again. Then 5 more times before the year is out. Short-term rates move faster than Citron's long-term positions can absorb. The strategy that produced 20 years of gains begins destroying capital at a speed no one in the county had modeled. Because no one had modeled a scenario where rates moved that fast in that direction over that period. In December 1994, Orange County files for bankruptcy. The loss is $1.7 billion. It is the largest municipal bankruptcy in American history at that point. The schools lose funding. The county workers lose a portion of what they were promised. Citron later says he did not fully understand the instruments he was using. The risk was not hidden. It was hiding inside 20 years of conditions that never tested the strategy. And the 20 years of success was the thing that made everyone stop looking. The surface lesson is that Citron took on too much risk. But that is not what happened. What happened is that everyone involved had built their understanding of risk from a dataset that had never included the conditions that destroyed them. The model was not wrong because someone made an error. The model was wrong because the event it could not price had never appeared in the historical record they were working from. This is not a story about one man in one county in 1994. The same structure appears in Iceland in 2008 when 3 banks with combined assets 10 times the size of the national economy collapse inside a week because the global credit conditions that made their strategy profitable reversed in a way their models had never tested. It appears in the Lloyd's of London insurance market in the early 1990s when a series of large catastrophe claims, asbestos liability, Piper Alpha, Hurricane Hugo, arriving in the same short window, produced losses that wiped out syndicates whose entire pricing structure had been built on loss histories that had never seen that combination of events at once. Different industries, different decades, same structure. The model was correct for every condition it had ever seen. The condition it had never seen arrived, and the model had no answer. The reason intelligent people keep walking into this is not stupidity. It is that the models that fail are built by people who are paying close attention to the available evidence. They are doing exactly what careful analysis asks them to do. The problem is that careful analysis of the past cannot show you the event that has never happened. And the financial event that has never happened is precisely the one capable of producing the kind of loss that does not recover. You are running a version of this right now. Your income comes from one source, or two, but the structure is the same. One employer controls your salary. One industry defines your employable skills. Your savings are spread across assets that are all correlated to the same underlying conditions. When times are good, they all go up together. When the condition that none of your planning anticipated arrives, they will move together in the other direction too. You have diversified inside the range of normal. And the range of normal is not where the catastrophic loss lives. You are probably not watching the second and third order effects. What happens to your job if your industry shrinks by 40%? What happens to your savings if the inflation assumption your retirement model used turns out to be wrong by 3 percentage points over 30 years? What happens to your insurance coverage if the event that triggers it is classified in a way that lets the insurer decline the claim? You have not thought about those things in detail because they feel unlikely. And they are unlikely, right up until they are not. Stop trying to predict which specific event will arrive. You cannot. Nobody can. The event that ends you will be the one nobody was pricing. That is not a paradox. That is the definition of the event. The principle is this: position yourself to survive the thing you cannot name, rather than to profit from the conditions you can see. That means keeping a portion of your finances genuinely outside the system you are betting on. Not a different fund inside the same structure. Something that moves differently. It means avoiding the strategy that produces steady gains in normal conditions, but has no flaw in abnormal ones. The steady gain is the thing that stops you from asking what the flaw is. And it means accepting smaller returns in exchange for the kind of structure that does not have a single point of catastrophic failure. What you give up is the feeling of optimization, the sense that your money is working as hard as it can. What you get in return is not safety. Nothing gives you safety. What you get is a structure where the event you cannot predict does not end the game entirely. You have been measuring your financial intelligence by how well you have done in the conditions that have existed so far. That is a reasonable thing to measure. It is also completely uninformative about how you will do when the conditions change in a way you have no experience of. The risk you are managing is not the risk that will destroy you. The risk that will destroy you is the one you decided was too unlikely to plan for. And the decision that it was too unlikely to plan for was made using the same data set that cannot show you it is coming. That has not changed. Knowing it has a name does not make the event smaller. It makes you the person who cannot look at their financial plan and honestly tell themselves they have accounted for it. Next video. The people who got out before every major financial collapse in the last 100 years were not smarter than the people who didn't. They were positioned differently before the information arrived. The difference between surviving a catastrophic event and being destroyed by it is almost never made in the moment. It is made years earlier in a decision that felt overly cautious at the time. The math behind why preparation and prediction are not the same thing will change what you do with money tomorrow. Most people confuse the two their entire lives.